CME moves to sue the CFTC over its approval of U.S. perpetual futures. CME Group, the world's largest derivatives exchange, is preparing to sue its own regulator. According to a report from Wu Blockchain on June 18, 2026, CME plans to take the Commodity Futures Trading Commission to court over the agency's decision to allow perpetual futures to trade onshore in the United States. The dispute pits the incumbent of regulated fixed expiry futures against the product that has dominated crypto trading offshore for years. Perpetual futures, contracts with no expiry date that track spot prices through a funding rate mechanism, were long kept out of reach for U.S. retail traders. The CFTC's recent move to permit them changed that, and the largest player in the existing market is now contesting the legal basis for it. A rulebook fight, not a price story. This is a market structure fight rather than a market-moving headline. As of June 18, 2026, the broader market sat in the red, with Bitcoin at $64,547, down 1.8% on the day, and Ether at $1756, down 2.2%, against a fear and greed reading of 22. None of that is a reaction to the CME news. The story matters because of who is fighting and what they are fighting over, not because of a candle on a chart. CME built its derivatives franchise on contracts with a set expiry: quarterly Bitcoin futures, monthly contracts, options with defined settlement dates. Perpetuals work differently. They never settle on a calendar date. Instead, a funding rate paid between long and short holders keeps the contract price tethered to spot. That design is why perps became the default venue for leveraged crypto trading on exchanges outside the US, and why bringing them onshore reshapes the competitive map for a firm whose moat was the regulated expiry-based contract. The onshore perps wave CME is pushing back on the CFTC did not approve perpetuals in isolation. Over recent weeks, the onshore perps market has been taking shape in public. Kraken launched CFTC-regulated perpetual futures for U.S. traders, bringing a product that used to require an offshore account into a domestically supervised venue. Open interest in the new onshore perps has climbed fast. TradFi perps recently passed Bitcoin in open interest as the format spread beyond crypto-native venues. For CME, that trajectory is the threat. A regulated perp that any U.S. trader can access competes directly with the exchange's flagship futures complex, and it does so with a contract structure CME does not lead in. A lawsuit aimed at the approval itself is a way to contest the terrain before rivals entrench, rather than try to outbuild them on a product the regulator has already blessed for competitors. The regulator in the crosshairs suing the CFTC is an unusual posture for an exchange that operates under the agency's oversight every trading day. CME is a designated contract market regulated by the same commission it now intends to challenge in court. That tension is the heart of why the story travels. The incumbent is not lobbying quietly through comment letters. It is reportedly heading to litigation against the body that writes its rules. The legal specifics of the planned suit were not detailed in the initial report, and the exact claims, the venue, and the timeline remain to be confirmed. Treat the precise legal arguments as unconfirmed until a filing is public. What is clear from the report is the direction. CME is contesting the CFTC's authority or process in approving perpetual futures, and it is doing so as the market leader with the most to lose from a level onshore playing field. A court challenge does not freeze the approved products. Onshore perps that already launched can keep trading while the case proceeds, so the immediate effect on traders is limited. The longer-term question is whether the legal challenge slows new entrants, reshapes how the CFTC frames perpetual approvals, or forces clearer rulemaking on a contract type the U.S. market is only now adopting. Stakes for the broader market perpetual futures sit at the center of how crypto is traded, and the question of how they are regulated onshore touches everyone from active traders to the venues building products around them. A lawsuit from the largest derivatives exchange against the regulator that opened the door is the strongest signal yet that the onshore perps transition is contested, not settled. For anyone watching the convergence of traditional derivatives and crypto-native products, this is the line where the two worlds collide directly. The incumbent is not adapting to perpetuals so much as challenging the rule book that legitimized them. The outcome will shape which venues can offer the contract, under what terms, and how quickly the U.S. catches up to a market that matured offshore.